Right, 11 o'clock, let's get going because we've got a fair bit to cover today. And so our guests this week are the managers of Vietnam, so Vienna Capital Vietnam Opportunity. But Richard and I are going to be talking about some news first. So Momentum Multi-Asset Value and RM Infrastructure from me, and then Home REIT and LondonMetric CTProperty from Richard. So Momentum Multi-Asset Value first. This is a fund that's been around for a while. And hasn't really covered itself in glory recently, as you can see here. But it has had a 0% control mechanism running for a while, and you can see that that's been keeping the whole share price close to the NAV for quite a long time now. The returns, as I say, are not fantastic. They're not helped by the fact that this is to some extent a fund of funds, and it does hold some closed-end funds, and discounts are widened, as we know. And that's dragged down returns a bit. But also this benchmark that is set itself here, I think, is unrealistic. It's been around for a long time. Launched in 2005 as Midas Income and Growth. Kept changing its name because the fund manager kept getting bought by different people. But since 2020, it's been owned by Momentum Global Investment Management. The original investment team is gone. But the current team of four there, one of those actually was there at the beginning. And the objectives, I say, it's targeting inflation plus 6%. I think that was always never going to happen, even when inflation was 1 or 2. It just seemed way too challenging to me. It was done because they thought the old target, LIBOR plus 3, was not sufficiently challenging. And to be honest, we agree with that. But there is no sort of perfect answer to what the right benchmark is for these flexible investment funds that can invest across different asset types. Anyway, I think CPR plus 6 was not really doable. Anyway, so discount control mechanism, they started talking about it in 2015. They kind of promised they were going to do it. The discount came rattling in even ahead of the introduction of it. And it worked quite well to start off with. They had 39.9 million shares in issue when they introduced the thing. And by the time you go to sort of October 19, it was 49.3, so they actually had a fairly good chance to expand the fund. But COVID was a real problem for it. The value style that it's sort of got embedded into what its approach didn't really work. And obviously, again, discounts widened, so that hitting the valuation of its closed-end investments. And as the NAV took a dive, people started selling and the fund started to shrink. You get to a sort of situation today where there's actually only 26.9 million shares in issue and a market cap of about 40 million quid. So it is too small. The board also points out the fact that the ongoing charges ratio is too high, and that's partly because it's a fund of funds, so it's got layers of fees on fees. And it's proposing that it rolls over into the manager's equivalent open-ended fund, which is done okay. Those two lines there, the top fund is the fund, the bottom line is the IA sector benchmark. So it has outperformed that, which I think is okay, but obviously in absolute terms, maybe not as great. So they've suspended the discount control mechanism. We'll get some detailed proposals later on, probably in a month or two. Shareholders obviously need to approve this. It's unfortunate that there is no opportunity for rollover into a closed-end fund, but again, with these small funds, it gets quite expensive to do that. It's interesting that they're going to make the rollover option a default, so you're going to have to tick the box that says cash if you want to take cash, but obviously you tick that box, you can then go out and buy another fund, probably on a discount, and so therefore really not the end of the world for me. RM Infrastructure Income is a fund that I quite like. There's the sort of COVID hit to it there, that caused a kind of disconnect between the share price and the NAV. That fall in NAV really reflected a provision that they had to make, a generic provision for losses that might have occurred because of COVID. And then because for the most part those losses didn't arise, they kept writing that back into the NAV. So you get a drop in the NAV and then a recovery. So even though you've got this going on here, nothing was really going on. They've had to do something very similar recently, as we'll come on to in a second. But nevertheless, I think maybe they didn't explain that to shareholders very well, or maybe just people didn't quite understand it, or maybe they were just worried. So, but the discount opened up, and although it did close temporarily, it's sort of drifted back again now. And the returns, sorry, it's a bit fuzzy, but they're taken from their annual report, and the website's not working very well. So this is sort of off the internet. I think they've been okay, really. I mean, that averages out about 5.4% a year since launch, which is below their target return, and also below the NAV they've been distributing. So where you've had some fall in the NAV, it's kind of been because they've been distributing a little bit of capital. It's not the end of the world, but they have been doing that a bit. Nevertheless, it has actually made you a reasonable return, and well ahead of their return on equivalent leverage loans, which is this blue line down here. What it's doing, it's lending to small and medium enterprises in the UK. Because of what happened with COVID, they actually sort of repositioned the portfolio. So it actually ended up doing an awful lot of the sort of COVID loan schemes that were government backed. So it's a more or less sort of government backed income, which is quite sort of a nice thing to do while you could do it. But obviously that was always going to roll over. And so they decided to reinvent it slightly, change the name and refine the investment policy in July 21 to make loans in a kind of social, environmental, infrastructure sectors. And that's now about 59% of the portfolio. Very well diversified, quite high yields up front, and a 6.5p dividend, which again wasn't quite covered last year, but nevertheless, that's what it is. And that's the sort of breakdown of where it's invested. So some of these are still the coronavirus stuff, but they are rolling off. And then the new stuff is things like the care homes and that sort of stuff, energy efficiency. And I do think this is a reasonable fund. It probably isn't big enough, but that's part of the problem with doing a discount and being able to grow it. Because a lot of it is fixed income, as yields have risen, then that's been affecting NAVs too, but it's relatively short dated stuff too. So it has been able to keep churning the portfolio into higher and higher rates of stuff. And that will obviously carry on going the way we are at the moment. So the yield on the portfolio is gradually rising, which is good news. And they now reckon they can target a 7p dividend. So I do think that's quite attractive. And more of these direct lending funds, I think they could be growing. We could even see some launches in this area if markets settle down a bit and interest rates stay relatively high. They've had a kind of discount target of not less than 6%, and they've been using buybacks to implement that. So that has shrunk the fund a little bit. But because they were worried about the discount, they did introduce this sort of trigger thing here, whereby if it traded at more than the 0% discount over the 6 months ending 31st March 2023, they would talk about what they could do to provide investors with liquidity. And so that's what they've been doing in the past few weeks. And then in this week, they've announced not quite the results of that, but they basically said, we've been talking about what we're going to do, and we did actually get a merger approach in April. But part of the problem with that merger approach was there was no cash option. And the board is reluctant to engage fully with this thing until there's a cash option on the table, because obviously they feel that people want liquidity. So we'll wait and see what happens with that, but it does mean that it's kind of in play. So in the meantime, the board is undertaking a review, so looking at what it can do otherwise. So what I'd quite like to see is that the whole thing continues. That's my sort of preferred thing, but in a bigger fund, so it actually manages to do a merger. Managed wind down would be a shame. I think it wouldn't take too long given the liquidity in the portfolio, and there'll probably be sort of a rump that sort of lost it for a little bit, but it could happen. But I do think these are the sorts of funds that ought to be growing rather than shrinking at this point in time. In terms of what it might combine with. Some of these things are doing completely different stuff, but there are some obvious candidates here. Probably GCP asset-backed income is one of them, and it could be that that was one of the ones that approached them. We don't know. GCP infrastructure and Sequoia economic infrastructure, similar things. They're all on discounts, but you don't need to be trading at asset value to do a merger like this. Obviously, if you provide a cash exit option, then it's more likely to get taken up if you are trading at trading at discount. But nevertheless, I do think that the sort of combination of one of these probably makes a lot of sense. So we'll just have to wait and see what happens in the future. So that's me. I'm now going to hand over to Richard.
Thank you, James. Yeah, so an update from Home REIT this week. I talked about them a couple of weeks ago, having not gone through with the offer that they had from Blue Star. And I mentioned that AEW were likely going to be the new manager, and that's happened. So they're appointed this week. Now, I did mention before that they've got some experience in sort of social housing with one of their other unlisted funds, AEW UK Real Return, which over 50% is in sort of supported living and sort of healthcare type property. So they do have expertise and sort of personnel in this area. So that's probably what won them the mandate, I would have thought. So the immediate priorities is to obviously collect some rent. As you can see, the numbers there are just shocking. So in the quarter before, the quarter to end of November, just 23%, and it's gone down since then. So in the 5 months to the end of April, just 13% of rent collected, and it's just, so there's lots of things they need to do, but that's the number one thing. And I suppose what comes onto that is addressing the issues with properties that they've got in there. So some of their properties have been sort of in dilapidated states, not had any investment in them on improvements and refurbishments and stuff. And that's why the tenants aren't paying their rents, because they've been told that they were promised these refurbishments that have never come through, so they're withholding the rent. So that needs to be worked out. They've also said they're going to sell a number of their assets and review the portfolio and come up with a long-term strategy. So we're waiting to see on that. They certainly do need to sell, get rid of a lot of these properties and get some money in as well. They're also proposing a change to their investment policy. They've not given much detail at all, apart from that it will include the provision of shorter term leases, which they can't do at the moment under the investment policy as it is. So obviously, I think what they're going to try and do is renegotiate these leases with some of the tenants that aren't paying rent on shorter terms to try and appease them maybe and get some rent in. These will be put to shareholders, obviously, and hopefully we'll get some more details on that soon. So the management fees that AEW are have agreed, so they're not officially going to be appointed as a manager in AIFM until it's sort of approved by the FCA and stuff like that. So immediately they're property advisors, so they're going to start straight away and they're going to get £3 million a year until they are appointed. And then once they are, in the first 2 years, there's going to be a fixed asset management fee of £3 million a year, and then variable fees on disposals and rent collection. So they're going to take 10% of all the rent that they get in within the first 2 years as a sort of incentive. And then after that, the investment fee is going to be equal to 0.75% of NAV. Now, this compares to Alvarium, the previous manager, who was worked out at about £7 million a year. So a bit of savings there in the longer term. And then other updates that they've announced this week. So they've appointed Bill Starn, who's a sort of experienced CFO in sort of these kind of turnaround situations, as a consultant. And also there was a line in the announcement that their valuer, Knight Frank, has sort of terminated their services to the company, which I don't know how to take that really, because they were the guys that were valuing the property. And if you read the short seller attack, I don't even think they even saw the properties before they valued them. Well, they couldn't have done because they wouldn't have valued them at such high prices. So yeah,
they sort of got out before they were pushed.
Yeah. So that's where we are with that. It's going to be a long road ahead for them to bring that back. Yeah, maybe some shareholders would have gone out at 40p, which was the offer last couple of weeks ago, but it never got to that stage. But so that's them. So, and then another big announcement in the property world this week. So LondonMetric have come in with an offer to buy CTProperty Trust, which is a smaller, sort of more generalist REIT. So CTProperty shareholders will receive 0.455 LondonMetric shares, which values it at about 200 million, which is a huge premium to their share price, and a 6.3% discount to the NAV. And actually, if I was a CTProperty shareholder, I'd be jumping all over this, to be honest, to get into. LondonMetric are a very good outfit, and they know what they're doing. They perform pretty well over the last few years. So so the combined company will have about 3.3 billion in assets, and although they've got CTProperty have got a sort of more diversified portfolio, which is on the left there, a lot of it is in industrial and logistics, over 56% of it, which is obviously what LondonMetric want, and a core of their business is logistics, and especially the urban side, which they've been growing over the last 3 or 4 years. So when that's all put in, that the pie chart on the right shows what the combined company will look like. So the dark blue is all logistics stuff, broken down into urban, regional, and mega, which is the sort of big box stuff. And they've also got a sort of 4% in long income, which CT does as well, and that's a smaller part of their focus as well. So quite a lot of synergies there, more than I thought actually. When I first saw it come out, I thought, oh, I'm not sure about where the portfolio are going to line up, but if we look on the next slide, the top 5 assets in CTProperty's portfolio, all sort of distribution warehouses, like I said, all the urban. So if you look at the size of them on the right, square foot, sort of all in that sort of urban logistics sort of size frame, in good locations as well for urban logistics. So I think that was the main sort of attractiveness for LondonMetric was these quality assets. These are the top 5. There's obviously a few more that fits in their portfolio, and they could get it at relatively good value. Like I said, 6% discount to NAV. But as a CT shareholder, they've and a lot of their peers in that sector are all facing sort of difficult times at the moment, or massive discounts, have been for ages. So CT Properties was averaging over the last 5 years 23.5%, which is not sustainable. There's a lot of these companies similar to them, all this similar size, all doing similar stuff with similar makeups of portfolios, and it just makes sense to be merging a lot of these maybe together, or what we're seeing here, sort of the bigger guys coming in and picking them off. So in the next screen, we'll see some of the discounts. Ignore the top company. I don't know why they're still in there, but some of the discounts that these guys are on. So a lot of them 20% plus, up to almost 40%, which is staggering. And on the next slide, we see. Sorry, if we go back one, just to point out the on the right, furthest right column, just some of the sizes of these guys, sort of 300, 200 million, 400 million. There's just a lot of them all doing the same stuff, all with similar makeups of portfolios. There just needs to be a bit of consolidation here, I think, and that's what we're starting to see, and I'm sure we'll see a lot more of. So in the last slide, it's just the NAV performance over 5 years, and you see CT back sort of in the middle there. All of these figures have been hit by the valuation impacts of the last year. So none of them have got very impressive figures. But yeah, like I said, watch this space. I'm sure we're going to see a lot more of these type of deals and consolidation.
Great, thanks, Richard.